Most people think interest rates are fair. Rates go up, everyone pays more. Rates go down, everyone benefits. That's the story we're told. But here's the uncomfortable truth. When rates change, the system already knows who will win and who will lose, and it decides before you ever feel it. Not based on how smart you are, not based on how hard you work, but based on where you already sit inside the system. That quiet rule decides who gets rich when rates change, and it's shaping the world right now. Think about the last few years. Interest rates moved faster than almost anyone expected. Mortgages doubled. Tech stocks collapsed, then rebounded. Governments suddenly cared about debt again. Central banks became the most powerful characters in every economic story. And yet, while the headlines screamed chaos, something strange happened. Some people barely flinched. Others felt like the floor dropped out. Same economy, same rates, completely different outcomes. That's not bad luck. That's structure. To understand it, we need to stop treating interest rates like a policy tool and start seeing them for what they really are. Interest rates are not the price of money. They're the filter through which money moves. They decide who gets paid first, who can wait, and who can't. Here's the quiet rule. If you already own assets, interest rate changes tend to work for you over time. If you rely mostly on future income, interest rate changes work against you. That's it. That's the rule. Let's slow this down. Picture two people. One owns assets, a house, stocks, maybe a business. The other lives mostly on wages. They save what they can, invest when possible. When rates fall, borrowing becomes cheap. Future cash flows are valued more. Asset prices rise. The asset owner watches their net worth grow on paper, then in reality. The wage earner hears that the economy is being stimulated, but home prices move further away. Rents creep up and returns on savings disappear. Now reverse it. Rates rise, borrowing becomes expensive, asset prices wobble. The wage earner is told this is necessary. Inflation must be controlled, demand must cool. But their credit card interest jumps, loan payments reset, hiring slows, risk moves closer to their paycheck. Meanwhile, the asset owner adjusts. They earn more on cash. They buy when others sell. They wait. This is where people get confused. They assume rising rates punish the wealthy. Sometimes they do, briefly. But the system is designed so that those closest to capital can absorb shocks, while those dependent on cash flow feel them immediately. That's not ideology. It's math. Modern economies spent decades training themselves on falling interest rates. Every recession was met with cheaper money. Every crisis was softened with lower borrowing costs. Over time, the entire system adapted. Asset prices rose, assuming low rates were permanent. Debt became normal. Risk was pushed into the future. If you entered early, falling rates quietly multiplied your wealth. If you entered late, you paid higher prices with more leverage and less margin for error. Then, rates changed direction. And suddenly, the same system that rewarded borrowing began punishing it. But here's the twist no one talks about. Even when rates rise, the system still protects incumbents. Banks reprice loans faster than deposits. Large firms hedge interest rate risk. Governments roll over debt slowly. Households don't get those advantages. A mortgage resets, a credit line tightens, a paycheck doesn't adjust fast enough. The pain hits the bottom first, not because of moral failure, but because of timing. This is why interest rate debates feel so disconnected from real life. You'll hear phrases like neutral rate or soft landing, while people quietly change how they live. Fewer risks, delayed plans, higher stress. By the time policymakers declare success or failure, the wealth transfer has already happened. Because interest rates don't just move money, they rearrange leverage, and leverage is where power hides. Here's the uncomfortable math beneath the surface. Assets respond instantly to rate changes. Jobs and wages respond slowly. Markets price the future in seconds. Households feel the present month by month. So when rates move, asset owners react first. They sell, hedge, buy, or wait. Everyone else reacts last. That's why financial crises often start quietly, not with job losses, but with math breaking somewhere on a balance sheet. By the time the real economy feels it, the system has already shifted wealth. And then comes the narrative. We're told rates had to rise, or rates were too low for too long, or inflation left no choice. Those explanations may be true, but they're incomplete. Because the question isn't whether rates should change, it's who bears the cost first and who gets compensated eventually. Most financial advice focuses on behavior. Spend less, save more, invest smarter. But interest rates don't reward behavior, they reward position. Two people can make the same decisions and end up in opposite places simply because one owned assets before rates changed and the other didn't. That's why rate cycles widen inequality, not by accident, but by mechanics. Rates amplify what already exists. They don't create winners and losers from scratch, they reveal them. And here's where the irony lands. Cheap money trains people to borrow. Expensive money punishes them for listening. The system encourages risk, then charges interest for taking it. So when rates move again, and they will, the outcome won't be random. It will follow the same quiet rule. Those with optionality will adapt. Those with obligations will absorb the shock. And the biggest question isn't what rates will do next. It's how long a system can keep using the same lever, knowing exactly who it favors each time before the pressure shows up somewhere it can't be contained. Because interest rates don't just shape markets, they shape who gets time, and eventually, who runs out of it.